Treasury Secretary Scott Bessent's effort to calm the bond markets appears to be falling short. You see, U.S. borrowing costs are up again, and that will hit your wallet. When the government's cost to borrow increases, yours usually do as well. This week, Bessent announced a plan of a bond buyback. This is to help calm the market, which hit a nearly 20-year high Tuesday. But the impact was only temporary. 30-year bond yields hit a high of 5.26% yesterday. 10-year notes surged up to 4.71%. When asked about this, the Treasury Secretary dismissed the turbulence.
Anything that happens within a 24-hour period is noise. And, I think that once the market understands that we are focusing on fiscal consolidation and that we are trying to bring the market back into equilibrium in a thinly traded market, I think, I'm confident that bonds will continue declining.
CBS News contributor Javier David joins us now to explain what all of this means for you watching from wherever you are this Friday. Javier, good morning and welcome. First, what led to the global bond sell-off? What is the problem?
Yeah, it's important to note that turmoil isn't just one thing. It's the convergence of multiple factors at once. We've got the Iran war, we've got soaring oil prices, inflation, and the debt-fueled hyperscaler build-out of AI. But right now, at this moment, it's mostly a reflection of how badly major economies have really not around the world, not just the U.S., have kind of lost the plot when it comes to spending. There's too much debt. There's not enough buyers. And what that means is it's tarnishing the safe haven luster that bonds used to enjoy, have always enjoyed. It's debasing the dollar, which inflation was already doing. We're spending way too much, and growth alone, with respect to the Treasury Secretary, won't compensate for it. So bond investors are really signaling they're going to force us to get our fiscal house in order, whether we want to or not.
And so what then is the impact as finances get in order for the general public? Should people be worried about how much it will cost them to borrow?
Well, they should absolutely care, because this is sort of the bond market's version of for whom the bell tolls. And right now, it's tolling for our mortgages, our credit cards, our auto loans, and every other borrowing cost that makes life more expensive. So higher Treasury yields have this tendency of pushing up all the other costs across the economy. It's already pushed the 30-year fixed mortgage rate to 6.75. So basically, when Uncle Sam's borrowing costs rise, ours are sure to follow.
And so then it's even more important for viewers to understand the administration's strategy. The Treasury Secretary says he'll double debt buybacks, but market reaction wasn't as excited as I guess he thought it would be. So are investors confident in the administration's plan?
Right. So the Treasury Secretary suggests, the $1 trillion that we owe in debt is not a magic number. In his words, we can grow our way out of it. The bond markets aren't reflecting fundamentals, but the market's reaction shows investors vigorously disagree, and they're willing to test the government's resolve and go the Treasury into putting money where its mouth is. They've got a lot of different tools at their disposal that they can use to do it, but these are short-term fixes. The real solution here is the simplest one that unfortunately is going to be the most impossible to implement, which is getting government spending under control in a way that brings it in line with tax revenues and once and for all kind of takes the pressure off long-term yields.
All right, Javier David joining us from Dallas. Appreciate your insight, Javier. Thank you.